So chapter 6 talks about the inventory costing methods, and there are 4 different types of inventory costing methods that can be used. But before we get into that, I just want to provide an overview on what the inventory costing methods are used for, what they're used for, what they're all about. So the inventory costing methods, as you can see here, they're used to calculate the cost of goods sold, which is the expense that needs to be reported in a company's books once products are sold. And is also used to figure out what the ending inventory balance is going to be. And these methods are simply just assumption methods, which means that whatever actually happened doesn't necessarily translate into the company's books as it actually happening. For example, let's say you go to a retail store and you have all of these items that you are interested in purchasing. Then you have those items and you go to the register, the cash register, where the associate rings you up and you buy your items. You go ahead and buy your items. Once you actually purchase your items, the register is going to automatically report the revenue in the system. But how do they report the expense? The cost of each item is not going to be attached to each item. Just the retail price, the price that you're going to pay for those items, which they will recognize as revenue in their register, from their register into the system once you purchase them. So when it comes to reporting the expense, well, first off, before reporting the expense, companies first have to acquire the inventory. They have to acquire the items that they're going to eventually put out on the floor. The way how they do their acquisitions of these items is they may purchase these items in bulk. So they may go to a wholesale company or manufacturing company, and they may purchase the items in bulk. So they may purchase 1,000 items for a certain amount, or 500 items for a specific amount. But notice that since they're purchasing these items in bulk, you don't necessarily know how much each item costs. One item can cost $20, another item can cost $5, another item can cost $100, and then another item can cost $10. They can vary. So when you purchase these items in bulk, you can get an average cost per item by taking the number of items that were purchased divided by the total amount that was purchased divided by the number of items that were purchased to get your average cost per item. But you technically don't know how much each item costs. Since you're buying these items in bulk, it would take too much time to have somebody to go in and just figure out what each item costs and put that in the system. So because of that, this is why businesses are giving methods to report their expense once the items are sold and figure out what the inventory valuation will be that should be reported in their books. And as you can see, this is why we have inventory costing methods, which are simply just assumption methods. You're assuming that this is what happened in the business. So this comes close, depending on which method you use, because it should properly align with the revenue that's generated. This will come close to how, to what actually happens in the business operations. So for the first method, you can see here FIFO. FIFO stands for first in, first out. This is the most logical method that is out there to use because it assumes that the oldest purchases included in the inventory account were sold first. So it's the most logical method. So it goes in that proper order. Whenever you go to a place, whatever is first inside the store is assumed to go, be the first items that are going to leave the store. First in, first out. So FIFO, it is used, this type of inventory method is used by a lot of companies. I would use it if I had a business because, whatever I acquire first, my goal is to get that out first before I purchase new items. So that's one of the inventory costing methods. The next one here is the LIFO method. LIFO stands for last in, first out. So that's the opposite of FIFO, where it assumes that the most recent purchases included in the inventory account were sold first. So last in, first out. So whatever you purchased recently, you're trying to get that out the door first. Okay, so if that's how a business generates their revenue, where your most recent purchases are the ones that are going to be sold first, then it would be appropriate to use, or be more appropriate to use, the LIFO method when it comes to recognizing the expense and value in the inventory balance or inventory count, than using the FIFO method. Then you have weighted average. You don't have, you see that there's not a description here of weighted average. It could be better explained when I actually do an example, but I briefly touched on weighted average, where one part of it where you have to first, is weighted average. In order for you to figure out what the cost is going to be, you have to first figure out what the average cost per unit is going to be. And that's taking the total amount that you paid for items and dividing it by the number of items that you actually acquired to get your average cost per unit. So that's the first part when it comes to using the weighted average method to recognize the expense and figure out what the inventory valuation is going to be. Then you have specific identification, or specific ID. This is another one that doesn't have a description on here, but it is better to actually do an example to actually demonstrate what the specific identification method is used for. So when it comes to specific identification, though, it's in the name, specific ID. You're specifically identifying the cost of an item that you sold. So this is where you are taking the item and you are individually attaching that cost to that item. So once that item is sold, let's say for $10,000, you already know you're attaching that cost. So you already know what that cost is going to be on that specific item. So specific identification method, that can be used on customizable items, customizable orders, and orders that are large in amounts. Because if an order is a large in amount, let's just say you have a retail price or a price on the item to be sold for, let's say, like $2,000. You're probably going to use this method to figure out what's your profit on that item. So whatever you bought that item for, you may use the specific identification method, or it would be appropriate to use this method because this item price, the item price is really large in amount, and you want to not misrepresent reporting the cost of that item in your books by using other methods that could bring the cost of that item down when in fact it should be higher. Okay, but this will be better, I want to say, reflected as far as with the usage of the specific identification method when just actually going through an example. So that's it for these 4 inventory costing methods here. Again, these are assumption methods. This doesn't mean that whatever you record as an expense and what's the inventory valuation is, it doesn't mean that this is what it actually is, or this doesn't mean that this actually represents customers going into the stores and purchasing things, and the expense that's recorded actually represents what the customers purchase in that store in real time. It doesn't necessarily work that way. It'd be extremely difficult to figure that out. So that's why you have assumption methods. You have to assume that, hey, the business operates this way. So using this type of method, let's just say the FIFO method, properly aligns the expenses with the revenue that's generated.